Hi guys. I updated the sheet here up until a couple of days ago. Historical return since 1928, but since this year has been, I would say, quite volatile. Um, and also there has been lots of money printing. I was curious how much did they print, and also what are the actual returns of stocks and gold year to date. And yeah, it's actually not spectacular. Stocks, and that's the global stock market, not S&P 500. Huh? You can access this sheet on Google Sheets, but it's basically, what is it? It's the MSCI all country world index. So that's like much broader than S&P 500, and it's now on minus 4% for the year. Gold is at 19% return for the year in US dollars, and that's at a price of $1,800. And if you take a portfolio, the PP World, I think if you don't want to invest, that's the best you could do. It's a index fund, you could say, to compose yourself, and it's very simple: 75% stocks, global stocks, and 25% gold, and will do very well. But this year you only have 2%. On average, you have 8%. So actually, you have returns that are way below average still. Mm, for stocks, you have a bad year because on average at 9%, you have a loss of 4%, so that's 12% or 13% below average for this year. But gold, only have about 5% per year the past 100 years, but now we had 20%, so you had a great performance for gold year to date. Mm, and money printing, yes, 60% is a lot, but every crisis is like that. 2008 it was 80%. The year after was 30%, 8%, 30%. So it's a couple of years of massive printing during crisis. And we see that again now. But later on, they actually have a net, they reduce the amount of money in circulation, typically. So the average printed, I mean, the average inflation is only 10% the past 10 years and 9% the past 30 years only. I mean, this is massive theft, of course, but it's certainly not hyperinflation. That's a totally different scenario, and I don't think we have to fear that. But yeah, I mean, on average, it's 6% inflation. Because yeah, now it's 10% the last 10 years, but we go 10 years back, it was only 4% the last 10 years, or 12 years back, before the financial crisis in 2008. So on average, it's about 6%. That's still the case. So yeah, I think that we're still in the same cycle. Nothing has changed. As my previous videos on these long-term returns, you can clearly see this is blue is stock performance. Goes from very bad to very good, very bad the last 10 years, very good the last 10 years, very bad the last 10 years, and our average. The last 10 years, stocks have done only. Why is this? Not okay. Stocks have only done 7% the last 10 years. That's before inflation. After inflation, yeah, you deduct the 6%. It's only 1%. And 1% returns is just absolutely average returns. You can do very likely within 5 to 10 years, we will have average returns the last 10 years of not 1%, but 10% per year, like we saw here, and we'll likely see here again. And for gold, people are super bullish now, but we're still in a long-term downward cycle. And average returns gold the last 10 years after inflation is a loss of 3% per year as of today. But it can get much worse. It can go to minus 10% loss per year for 10 years in a row after inflation. I have to change this one also to 6%. So yeah, inflation has gone up a bit, but that doesn't really change much to the long-term cycles, and it's very important to keep an eye on that and put things in perspective. Like, yes, we bounced strong out of the crash that we saw in March, but we're still overall down and way down for the year. If you look at global stocks, not S&P 500 or Nasdaq, but global stocks, we're still way down. Huh? So from that perspective, are stocks overvalued? No, it's still way down. Huh? Yes, the economy took a very big hit, but stocks are also still way down for the year, and we still are in a long-term bull market for stocks. So it's dangerous to be bearish on stocks here because you want to be. Really need to have the long-term bull cycles right. It's the most important thing an investor needs to do. You have that wrong, it's a huge difference in performance. I have nothing else to add, so I'm going to keep it very short. Check the link in the video and check out these amazing historical returns. It's really, really very interesting. Look here in the beginning, I printed a lot more the Federal Reserve. In 1916-17, when they were created, the amount of money that they created, when the Federal Reserve was created, yet another government institution, nothing good comes of it, and here you see it in the numbers. Yes, what they did was so-called protecting US dollars meant in practice printing a lot more than before. And even though they were still in the gold standard, till the 1970s, that was in reality not the case because we were printing a lot out of thin air. I mean, net they printed 28% per year in the 20s, and that's the roaring 20s. Of course, they printed so much here because there was a war, a world war, a crisis. Then they print a lot. But because they print a lot, after that, when the war is over, the stocks go up a lot, the roaring 20s. I don't have the returns here, but it's a historical period. And at the same time, they reduce the amount of money in circulation a bit. And then the crash comes, or the 1930s crash, 25% off, another 40% off, another 10% off. That's an immense crash. But you don't see the returns here. They were also immense, very, very high. And then they blame the Federal Reserve of not printing enough here. They should have printed more, and that would have avoided the Great Depression. And indeed, they did not print a lot. Though by the middle of actually 1933, after when the Great Depression was clear, they did start to print. But luckily, not enough. Not so much as in the First World War. But yeah, so these are the numbers. Interesting, huh? Thanks for watching.